Since the birth of captive insurance in the 1960s, Bermuda has proved to be the most popular captive domicile, currently home to more than 1,100 licensed captives. Bermuda is also the world's third largest insurance centre, offering captives a one-stop insurance and reinsurance solution. In this report, we speak to some of the island's leading service providers to find out what's new in one of the captive industry's most mature domiciles, and how Bermuda is keeping up with increased competition, regulatory reform, and scrutiny from onshore lawmakers.
Bermuda was the first jurisdiction to form captives back in the early 1960s. So we've been in the business a long time. Over this period of time, we've developed a sophisticated infrastructure on the island, and most international insurance service providers are here in Hamilton, Bermuda, have a physical presence. We have a sensible regulatory environment and a very sensible and approachable regulator in the Bermuda Monetary Authority, the BMA. We developed our first insurance regulations in the mid-1970s, and thus we have a well-settled and I think finely tuned set of insurance regs applicable to captives.
There's longevity, but also innovation in the market. The first captive insurers were set up here back in the late 1950s, so we've had over 60 or 70 years of captives being established and built up on the island. That longevity means that we've got a very strong intellectual capital base here on the island, so we have good service providers in terms of the insurance managers, law firms, accountants, bankers and the other persons that are required to enable clients to set up and to continue to manage captives on the island. We also have a very well established regulator, the Bermuda Monetary Authority, that has over the years developed a strong regulatory regime for captives. So that longevity has basically meant that we've got a great infrastructure for people that are looking to set up on the island.
About 25 or 26% of the world's captives are based here in Hamilton, Bermuda. And in terms of the gross and net premium written by our companies, there is no other jurisdiction competing with us that can compare with our numbers.
Pretty well all of the interesting developments from rent-a-captives, segregated accounts companies that have been used over the years and brought other layers of possibility to the captive product have had their origin in the Bermuda market. So we remain a market where innovation is highly regarded, and that is an attractive feature which we know that many captive owners brings them to Bermuda.
Well, if you consider how Bermuda started in the captive business, it's been a place to innovate. Captives themselves were an innovation. So it's no surprise that the industry has grown around constant innovation in order to meet the demands of the client base.
We also in Bermuda, different from other captive domiciles perhaps, have a strong insurance market. And obviously with Bermuda, London and New York as the leading insurance and reinsurance sectors, that feeds into the captive experience that I think our clients receive.
Risk managers from overseas can do one-stop shopping in Bermuda. They can come in, secure reinsurance for their captives, and at the same time, they can buy D&O coverage for directors of their parent boards.
We have benefited consequently with an enormous growth in intellectual capital. The major brokers are all here in substance and in numbers, and support the industry full tilt. So the whole market is tuned to responding to the needs of its client base. And as a consequence, what has grown in Bermuda are obviously the classic extensions from captives, which include group captives, rent-a-captives, so-called, and as a consequence of those, segregated cell regulations and statutes which allow for a very mature market and a very flexible market.
This is not a side business. This is a very important aspect of the economic well-being of the island. And we're fortunate enough to have a government that understands that and is committed to maintaining Bermuda's position as the premier offshore insurance domicile and the logical choice for clients looking to form an offshore insurance captive.
Obviously, we are in a soft market cycle. There's capacity in the commercial market. However, we're certainly seeing our clients looking at deductibles, raising deductibles, for example. We're also seeing clients look at more unusual risks and looking at their total portfolio risk. So we're seeing employee benefits, particularly on a worldwide basis. Cyber risk is certainly an area that we're seeing more clients look at. Obviously, that's a somewhat complicated risk to actually get your hands around, but it's seen as a good opportunity for captives. I would say outside of lines of business, geographically, we're looking at growth in Canada and also Latin America.
One of the trends that we're seeing is really for established markets like the United States is the entry of mid-sized corporations with smaller annual premium that they're putting into a captive, really looking at and starting to use the captive concept for their own risk management purposes. Hitherto, the captive idea was really the province of large corporations. Benchmark was roughly $1 million of annual premium. If you didn't have that much that you'd be looking at putting into a captive, it probably wasn't an idea that you would be exploring much further with your brokers. In recent years, again, in established markets, particularly the United States, that the trend has been to see smaller programs being utilizing the same principles, not necessarily in a single parent pure captive structure, but rather those class 2s and class 3s that we mentioned earlier, multi-owned captives.
Segregated cell business also continues to grow apace, with uses varying from risk management in the US health sector to complex ILS transactions.
We've expanded the role of segregated accounts generally, so that not just insurers, but also, for instance, mutual funds and others can facilitate and use the segregated account machinery, often together to provide solutions. That's why ILS has been very successful and provided a very useful channel for funds such as pension funds to invest in non-correlated assets such as insurance, where they could not otherwise invest because they're not rated. Equally, they are also used for nuts and bolts cures for problems, as well as for new demands for services such as the consequences of Obamacare, which has generated open season in many ways for the providers of health insurance for employees throughout the US, and Bermuda has been a beneficiary of new structures for that as well.
So where are Bermudan captives putting their money? While high-grade bonds remain the staple, investment managers suggest now may be a good time to consider diversification into different asset classes.
Typically, a captive would want high-grade, investment-grade, fixed income to support the reserves on the balance sheet. This is the best estimate of future liabilities to be paid out. The surplus or excess capital can be supported by non-core fixed income, equities, and possibly alternative investments, which diversify away from the core fixed income portfolio, allow more growth in the portfolio, and capital protection. Any search for increase in returns should be taken in the context of increasing risk at the same time. We do advise captives and clients currently against materially adjusting tightly prescribed risk parameters solely to chase returns and increase yields. This is particularly important given what the principal investment objective of a captive is, to simply support the captive. We do see a number of clients at this time taking on extra risk-taking, and we would caution against this. Having said that, increasing return does not need to be overly complex. For example, investing in single A or triple B securities instead of double A or triple A could increase your annual return by 1 to 1.5% a year over the intermediate term. Other corporate securities that we like in the United States are high yield or non-investment grade securities. These are typically more risky. These kind of securities in a strengthening US economy should have sufficient cash flows to meet their bond obligations and should have low default rates going forward.
I think it's going to be a more challenging environment for managers of captive funds from an investment perspective than we've seen over the course of the past couple of years. We know traditionally captive investors have used quality government bonds, and in the past that's generated the returns that have been required. I think the reality is government bonds have performed much better than most investment analysts have been anticipating over the course of the past few years, benefiting from slower growth that we've been seeing, lower levels of inflation than was anticipated, far more aggressive stimulus programs, quantitative easing programs coming through from central bankers, and the fact that interest rates have been kept much lower for much longer than was anticipated. But I think the world is starting to change. Growth will start to pick up. We're already starting to talk about, at least in the United States, the normalization of interest rates coming through, and of course a pickup in inflation expectations as well. And that will have significant negative headwinds, I think, for quality government bonds. So it's about getting that balanced portfolio right. Now, we know that traditionally captives have been concerned about putting their money into equity markets, even though they're long-term investors, and we know that actually equity markets do perform better than other asset classes over a prolonged period of time. So I think what we should really appreciate from an investment perspective is it's about getting that balanced portfolio right and how much equity you should have within that portfolio. Equities are the most volatile of the There is a higher risk involved, there is greater volatility coming through, but even when you look at the boring old US stock market, it's outperformed most markets in most currencies for most of the past 30 years. The reality is if you want the opportunity for higher risk adjusted returns in a low interest rate environment, owning a slice of a publicly listed company has to be part of that solution. I still think the fundamentals for equity markets still remain strong. If you look at earnings growth, still remains robust. Valuations aren't expensive by historical standards. The dividend yield that you receive is still very valuable in this current environment. But what we've been saying to investors that have been looking at equity markets in the developed world, it's not all about the United States. Past few years we've said US, 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 put your money there. That's where we've seen the outperformance. Now we believe there's greater opportunity. You should be looking to increase your exposure geographically to include Europe as well. That was our call coming into this year, and we've seen significant outperformance from European markets. So it's about by being diverse within developed market equities, but also making sure your equity weighting is correct as you start to see this change in dynamics taking place. Government bonds coming under pressure, something we haven't seen for a long time. Equity markets, we still believe, will be outperforming longer term.
While captive money continues to flow into the developed markets, it's emerging markets like Latin America that offer the most potential in terms of new captive formation.
Well, emerging markets in general and Latin America in particular is playing a very important role in terms of the new captive formations. In recent years, as much as a third of new captive formations in Bermuda have come from the Latin American region. And we've been seeing in recent years most of the activity coming from the northern part of Latin America, particularly countries like Colombia, to a lesser extent Venezuela, Panama, Mexico. Large multinationals involved in industries such as transport, infrastructure development, communications, natural resource development have been the leaders. Many of them are state-owned or partly state-owned, which again gives a further stamp of approval within the local economy when you see your governments are using the products. And we're starting to see that move into secondary users such as financial institutions and manufacturing concerns. The same development historically happened in Europe and in the United States, so we're seeing similar trends in how the captive concept and how it's being used is playing out in Latin America.
But despite Bermuda's continued popularity, offshore centres are under intense scrutiny, and Bermuda is no exception.
I believe there's a perception that there's an onshore-offshore debate. Certainly from a Bermuda perspective, we, to be honest, haven't seen that. Together with the Bermuda Monetary Authority, the Bermuda Insurance Management Association looked at a history of clients moving from offshore to onshore, and statistically it didn't stand up, but there's a perception that is occurring. Secondly, I'd say there's a perception on cost. And again, when we actually match up a client to a client or potential client, whether it's in Bermuda or another domicile, we tend to find that if we match them up exactly, that the cost is not so great in Bermuda. So again, there's a perception of cost. And obviously there'll always be regulatory issues from outside where we see various entities sort of looking at Bermuda and to a certain extent lumping Bermuda with other offshore jurisdictions. To be honest, I think we have the Bermuda Monetary Authority as a strong regulator, and I think they're very useful in countering those perceptions.
I think it's important to think of Bermuda as an offshore financial centre and not a tax haven. I think it's very easy for people onshore to lump together offshore jurisdictions and just give them the tax haven tag. Bermuda's a long-established offshore financial centre with a large insurance and reinsurance industry. The reinsurance industry is the third largest in the world. And so Bermuda has always had a high degree of regulatory oversight for both its insurance industry and other industries established on the island.
Bermuda, like all offshore jurisdictions, is under ever-increasing scrutiny from international regulatory bodies. However, we've been very fortunate on the insurance side of things that the Bermuda Monetary Authority, the BMA, has been able to secure good working relationships with a number of international insurance regulatory bodies, such as the NAIC and the IAIS. We have a seat at the table at these meetings, so the views and positions of Bermuda as a jurisdiction are well represented. In the past few years, we've also been granted qualified jurisdiction status by the NAIC, which is a tremendous compliment to the jurisdiction and to the work of the BMA. This puts us alongside countries such as the UK, Ireland, Switzerland, and Germany. And no other offshore insurance domicile competing with us in this space has been able to secure such a designation.
We are on the OECD's whitelist as a result of having tax information exchange agreements with a large number of jurisdictions. On the insurance side, we're looking to have Solvency II equivalence and to have the captive insurance market carved out of the Solvency II requirements. And our regulator, the Bermuda Monetary Authority, is actively engaged with other global regulators to ensure that we're meeting the highest level of standards.
Bermuda's always been a leader and likes to see itself at the vanguard of international developments for insurance and reinsurance generally, and captive insurance and reinsurance specifically.
Keen to stay at the crest of global reform, Bermuda has designed an equivalent framework to Europe's Solvency II, which experts agree will be more forgiving for captive insurers.
Bermuda decided early on that it would seek to obtain Solvency II equivalency for its jurisdiction. It's important for the entire industry, not just the captive sector, but also the commercial reinsurance space, given the expected barriers to entry into the European market for any non-equivalent jurisdiction. In doing that, in developing a Solvency II compliant regulatory framework, Bermuda had to keep in mind the sometimes competing interests of the different areas of the insurance sector. So for the captive owners, by and large, they are mainly attracted to regulatory efficiency, not having a lot of red tape to deal with, being able to use their capital efficiency, having relative freedom related to the risks that are being underwritten, of course, but having relative freedom within those parameters. Largely, the success story of Bermuda in this area has been that we've been able to achieve the best of both worlds, as it were, with bifurcated equivalency or segmented equivalency, where there's been a recognition that captives, the classes 1, 2, and 3, are limited purpose insurers. They have some restrictions on what they can do, in particular relating to third-party risks that can be written in the scope of that. And within that, they have a level of regulation which is appropriate to them.